Advanced price action trading strategies use a combination of chart patterns, trend analysis, and Fibonacci retracements. These methods can be used to identify potential support and resistance levels, as well as entry and exit points for trades. In addition, traders can also learn how to recognize a trend by watching for certain candlestick formations. A pin bar pattern, for example, indicates that buyers and sellers are struggling at a key level. Trendlines are important tools for analyzing the price movement of assets. They can help traders identify the direction of a market and determine when it's time to buy or sell. However, some experts believe that a trendline is not a reliable tool alone and should be used in conjunction with other tools such as support and resistance levels and candlestick patterns. These additional tools can provide a more accurate analysis of the market, and they are especially useful in identifying trends that may be influenced by external events. Trend lines are often drawn using multiple price points. They can connect a number of highs or lows, and they can even be based on a combination of peaks and troughs. The number of points used to construct a trend line will vary, but most analysts recommend that the trend line should touch at least 2 prices. This will ensure that the trend line has sufficient strength to be used in trading decisions. The slope of a trend line can also be important in determining the market direction. A steeper trend line suggests a stronger trend, while a flatter one indicates that the market is in a range. Some advanced price action trading strategies involve the use of trend lines in conjunction with other indicators such as Fibonacci retracements and chart patterns. These techniques can help traders identify trade entry points and exit points and improve their profitability. However, they require more practice and effort than simple trendline strategies. Traders can also apply more than one trend line to a chart to create channels. For example, traders might draw a trend line connecting the highs for a period and another to connect the lows in order to create an ascending channel. When the price breaks out of the channel, it signals a potential trend reversal. A trading strategy based solely on trend lines can be difficult to master, as they may not provide specific indications of where to place entry orders. To overcome this, some traders choose to use other indicators, such as support and resistance levels or candlestick patterns, to confirm their trading decisions. This way they can avoid costly mistakes and maximize their profits. Moving averages. Moving averages are an important part of technical analysis. They are used to identify price trends and to help traders determine support and resistance levels. They can also be useful in identifying market reversals. There are many different types of moving averages, ranging from simple to exponential. Each has its own advantages and disadvantages, and a trader can customize them to suit their trading style. The most basic moving average is the simple moving average, or SMA. This is calculated by averaging the sum of the number of data points in a given time frame. This method is easy to calculate and works well with charting software. Other types of moving averages include the exponential moving average and the weighted moving average. These methods are designed to react more quickly to current prices and may be a better choice for short-term trading. Traders can use moving averages to identify trend changes by looking for crossovers between the price and the moving average. A crossing above the moving average is a bullish signal, while a cross below is a bearish signal. This strategy is called trend following and is one of the most popular ways to trade stocks. It is a simple, reliable method that has proven to be successful over time. There are a few caveats, however, when using this strategy. First, it is important to select a time frame that is appropriate for the trading environment. Second, it is vital to know that a moving average is not a perfect indicator of price trends. It can lead to false signals if the moving average is too long or if it is too responsive to recent prices. There are several moving average strategies, such as the crossover, envelope, and ribbon. Each has its own unique approach to analyzing market trends. The basic idea behind all of these strategies is to find a trend and identify entry and exit points. Moving averages are a key component of any trading strategy, and they can be used in conjunction with other indicators such as trend lines and candlestick patterns. Fibonacci retracements. Fibonacci retracements are a popular trading tool. They can be used to identify support and resistance levels and price targets. They are based on the Fibonacci sequence, which is commonly seen in nature, art, and architecture. They are also a common element in advanced price action trading strategies. A trader can use a software program to create Fibonacci retracements. They can connect any 2 points that they consider relevant, typically a high point and a low point. The percentage levels provided by the ratios derived from these points are areas where the price may stall or reverse. The most popular ratios include 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Although they are not as effective as trend leans, Fibonacci retracements can still be useful in some cases. The key to using them is to understand the logic behind them. Traders must be aware that they do not always predict market behavior accurately. They should also avoid relying on them alone, as they can be misleading. Traders can use a combination of retracement levels and other indicators to confirm their perceptions of support and resistance. They can also track the Relative Strength Index, RSI, to determine the momentum of a stock. By doing so, they can improve their chances of success and reduce the risk of losing money. For example, if a stock is in an uptrend and reaches a resistance level of 61.8%, the trader can place a buy order. The trader should also set a stop loss at the 61.8% level, as a return below this point could signal that the stock has failed to move higher. Another method to identify support and resistance levels is to use a moving average convergence divergence (MACD) indicator. This indicator measures the distance between a moving average and its signal line, which is another key component in trading strategies. It is a simple and reliable tool, but it should be used with caution. The MACD indicator can be influenced by emotions and short-term market fluctuations, making it prone to false signals. Candlestick patterns. Candlestick patterns are an important part of technical analysis and can be used to identify trading opportunities. These patterns are created by up and down movements in the prices of an asset. They can be used to generate trading signals, but should be used in conjunction with other indicators. They are also useful for identifying market indecision. Some of these patterns provide bullish or bearish signals, while others are neutral. In addition to indicating price momentum, candlestick patterns can help traders understand the psychological aspects of market behavior. Traders who are familiar with these patterns can make more informed decisions about their trading strategy. They can use them to trade a range of instruments, including indices and stocks. They can also identify key levels of support and resistance. A candlestick chart shows 4 prices points, open, high, low, and close for each day, and displays them as a single graphic. The size and shape of the candles in a candlestick chart can tell a trader a lot about buying and selling pressures and other market conditions. These patterns can be used to predict future trends and identify support and resistance levels. There are many different candlestick patterns, but the simplest ones include a long real body and a small lower shadow. A large upper shadow indicates strong selling pressure, while a short lower shadow suggests that buyers are pushing prices up. A doji pattern is another indicator of indecision. These candlesticks have equal opening and closing prices. One of the most popular candlestick patterns is the hammer, which occurs during a downtrend. It is characterized by a long black candle with no upper shadow and a small real body. This pattern is a strong bearish signal and indicates that sellers are gaining control of the markets. Candlestick patterns can also be used to identify reversal patterns. For example, a doji pattern can indicate that the bulls and bears are equally pressing on prices, causing them to move in a sideways fashion. The hanging man is a similar reversal pattern that appears during an uptrend and signals a reversal in the uptrend. Another reversal pattern is the 3 black crows, which involves 3 long bearish bodies that have no upper shadows.